Hello everybody, we are Dynamic Wealth Management and today is Tuesday, May 7th. My name is Gary Luna, this is Grant Haddon. Adam Carlini is also with us. This is our market update. The market's had a good year so far. We got out of tax season pretty well, survived that. We're moving into the summer months. A lot of clients starting to move around, get out of the heat a little bit. And it looks like the market's having a little bit of heat. Volatility coming back a little bit today.
Yeah, as Gary said, the market's been really good so far this year, but last couple days has been a little bit bumpy. So we'll get into why that is and what we see happening out there. Let's jump into the charts.
Welcome, folks. Today is Tuesday, May 7th, 2019. Just want to give you a quick update as we move into the summer months. We usually have what's called an investments for breakfast. That we do every Tuesday, or every other Tuesday, I should say. That's normally done from about October to April of each year. And so, but as we move into the summer months, we have a lot of clients that go out of town. And so we'll take a break from that event. But we are still working all summer. So please give us a call if you'd like to meet with us. We'd love to sit down and do a comprehensive review of your estate plan, your tax plan, or your investment plan. We'd love to help you out. And we normally do 1 to 3 consultations at no charge and give you some great information. And if nothing else, we make some good friends along the way by doing that. The office number, again, if you'd like to get a hold of us, is 623-466-6060. Let's go ahead and talk about where we are as far as our general view of the markets. We are definitely in our green zone. Right, you can see that we're actually a good distance into our green zone, and we'll talk about why we're there. But basically, the market has been in an uptrend throughout the year and continues to look pretty good, even with recent news that's coming out with tariffs that we'll talk about here in a second. That means that we are leaning into risk and away from conservative allocations. So we'll talk about that and give you some more indication and more information as to why that's the case. Let's talk about then, speaking of recent volatility. So this was an article that came out today from Market Watch, and it basically says stock market strategist Thomas Lee is his name, basically says that Wall Street should shake off Trump trade anxieties and buy this dip. So what are they talking about? Well, apparently, over the last few days, our president, Donald Trump, has ramped up his commentary, as he loves to use Twitter, in regards to the trade talks between the United States and China, right? And in fact, some of the tweets indicated that apparently the U.S. possibly could raise tariffs on about $200 billion in U.S. Chinese imports to 25% from the current 10% that we are at on current tariffs. So obviously the markets got worried. The markets had been looking forward for several weeks now, even months, to the negotiations that are currently underway as far as the trade talks, and any negatives as far as that have the potential to confuse and worry the markets, and that's exactly what's going on. So on today's market, we saw the Dow, just to give you an example, volatility came back to the Dow we hadn't seen for quite some time, and the Dow moved something like about 600 points. I think it ended about 480 some points down, but it was down as low as about 650. And then it picked up at the end of the day, which was nice to see. So, of course, we'll watch that, and we'll put that into perspective as to where we've been and where potentially we'll continue to go. Grant will get into more of the charts and give you an idea of our trend and how strong that is. The other thing I would point out, recently, this came out Friday of last week, and that was May 3rd, is our employment situation. So one of the biggest reports of the month that is tracked by the financial markets is the jobs creation report, and it definitely surprised to the upside. This information comes out from Econoday, which anybody can go out to their website and see some really great information on the economy for U.S. and international markets. But the consensus was somewhere between about 160 to about 240 brand new jobs being created. The actual number came in much higher at 263,000, which was tremendous. Not only that, but the unemployment rate trickled down to 3.6%. And so Econoday and their analysts, this is how they sum that up, or the highlights, says that sound you hear is the economy revving up. And then they basically report that 263,000 new jobs were created in April. And the fascinating thing about the 3.6% unemployment rate is it's the lowest it's been in 49 years. That's tremendous when you think about the implications of that. And obviously, when people are employed, then they are more confident to spend money. When they spend money and invest their money, obviously that's what pushes the economy. The economy is dependent, about 2/3 of the economy is dependent on the consumer. And so that's a great thing to see. And with those two bits of information, we'll go ahead and push on into the stock market, and we'll give you some charts and more information on price action.
All right, let's jump into the stock market charts and show you what we've been seeing out there. So here's a chart of the last 9 months, and it's comparing bonds to the dollar, to stocks, to commodities. So what I want to pay attention to mainly is this black line, the stocks line. So you'll notice if we go back to September, October of 2018, we had a steep drop, right? The last quarter of 2018 was pretty rough. It was about a 20% drop. But since then, it's bounced back, and 2019 has been a strong year. So actually, this first quarter has been really good. But when you take into consideration the drop that we had, you're kind of back even, right, to October of 2018 after this drop, the V bottom out, and especially now. I mean, we're from the last 9 months, stocks have made 0.38%, so kind of flat based on that time frame. Now, the nice thing is in our core ETF models, in the end of October, we made some significant allocations to reduce risk. So we didn't have this much volatility like the stock market did. And into 2019, we were able to rotate back in, and we've been participating with the recent gains that we've had here in the model. That being said, bonds actually over the last 9 months have outperformed stocks, which is pretty rare. Kind of holding in there, holding flat, but a small gain and paying their coupon rates as well. So anyways, want to speed this up. We don't want to have this video take too long for you. So here's the S&P 500 over the last year. You'll notice that the previous all-time high was end of kind of mid-September. And we had that big drop just like we just showed. And the point to make on this chart is we did hit all-time highs just recently. We set a new all-time high. Since then, we've had a little bit of volatility for some of the reasons that Gary talked about. But, we have some good support beneath us here. So this drop, to us, at least looks short-term for now. So here's the Dow, same thing. End of September was its all-time high, and it never got quite back to all-time highs before this recent dip. The NASDAQ did make a new all-time high just recently, but kind of the same story as the S&P 500. It's got some significant support down beneath it here, and so we'll obviously pay close attention to those crossovers, but for now, nothing too concerning. The Russell 2000 was unique because it hasn't come anywhere near its all-time high that it made in September. So it fell worse than the others and actually hasn't made it back. So we're not really excited about small caps here. Here is the asset classes of the S&P 500. The S&P 500, so this is for the last 6 months. For the last 6 months, the S&P 500 is up 3.5%. NASDAQ or technology up about 6.5%. Small caps about similar to the market over the last 6. Developed, emerging markets, the dollar, commodities have been down. You see that's a pretty regular thing. When the price of the dollar goes up, you see commodities go down, and so that's held true again. REITs and real estate have gone up, which is pretty interesting. If you look around just anecdotally, you see new homes being built everywhere and prices going up, and so that's reflected here in the REIT ETFs as well. All right, here's some other sectors, ones that didn't do so hot over the last 6 months. So discretionary did okay, communications did okay, technology again did good. What were some of the losers over the last 6 months? Well, energy, with all the stuff going on with oil and some of the other energy, has struggled. Healthcare has struggled over the last 6 months, and financials and staples are kind of flat. Again, real estate done very well. Okay, so what does that mean for us in our models? Well, our core ETF models are in a green zone, I think, as Gary mentioned earlier. What that means, if you're a growth client, you're 100% in our equities or our stock type positions. If you're moderate, you're at 80-20, 20% defensive, 80% equities. And if you're conservative, you're at a 60-40 right now. So here's your current allocation, and unless the market really gets dicey and pushes us to a yellow zone, we'll stay in this allocation until then. If you're in our sector rotation model, here are our 8 positions that we're holding currently. Healthcare was able to squeak in there after the recent, after some of the dips that it's had, and made it a value buy for us. Communication, home builders, discretionary, gold, consumer staples, real estate, as we showed, was performing very well, and utilities. These are the ones that we don't have any part of right now for the next quarter. So, that being said, I don't want to take up too much of your time. In this video, we just give our opinion, and we give you some things to think about and try to educate you on what's happening in the markets. Don't make any buys or sells without consulting with your financial professional. Thank you so much for watching our video, and we will do another one soon. Have a great day. Bye-bye.